QuickBooks Pro Desktop 2021. Forward contract for speculation that foreign currency will strengthen initial transaction. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Problem 2 Multiple Currencies Practice file. We currently have the Open Windows open. You can open the Open Windows by going to the View dropdown, selecting the Open Windows list. We're first going to consider this transaction in Excel so we can see a more transparent look at the transaction with debits and credits. Then we'll come in here and see how to put that into QuickBooks so QuickBooks can help us to automate the process. So I'm going to go back on over to Excel. We have our information. We have a 120-day forward contract to purchase Australian dollars. Now these are important or useful because we're doing it just for speculation purposes here, but remember that you could use this to kind of hedge other risks that might be in kind of normal type of contracts and transactions that happen to be in foreign currency. So the basic layout here is that we're thinking that the Australian dollar is going to get stronger related to the current rate that we're going to be using, and therefore this is a speculation based on that assumption that we could benefit from that assumption, right? And then in future applications, you could use that same kind of assumption or same thought process to say it might strengthen, and that could cause us a problem, and therefore we would want to hedge, use this possibly as a hedge against some other kind of exposure we might have for foreign currency transactions. Okay, so that means what we're gonna do is we're gonna put this on the books, and we want the Australian dollars. We're going to be receiving 100,000 Australian dollars in the future. So we're going to get the Australian dollars in the future. So we're going to have a receivable that we're going to be getting in the future in the foreign currency. And we're going to call that a special kind of named receivable. We'll have to abbreviate in QuickBooks because it's way too long. We'll call it the foreign currency receivable from the exchange broker here. And we have this little indication at the end, the AUD, that's going to be Australian dollars. So we're going to have to value it for our books in some way, shape, or form, and the US dollar equivalent of the 100,000 foreign dollar units that we will be receiving in 120 days. Now, the other side of the contract is that we're just going to have a payable. So we're going to put the payable on the books. We are also going to pay in 120 days. So what's the point of this contract? Well, we're going to be paying in US dollars. So that means that there's two sides to this contract. We're going to be getting something in foreign currency units. We're going to be paying for it in US dollars in 120 days. So then we have to put this on the books and say, okay, well, how am I going to value this as of today? You would think then, if it was a normal kind of contract, you would use the spot rate for today. But because this is a forward exchange contract, you're going to have speculation as to what the rate will be in the future. And the broker is going to be speculating and using the market on people's analysis on what they think the spot rate or what the rate will be, the forward rate will be in 120 days when they're actually going to be giving you, or us in this case, the 100,000 Australian dollars. So that's kind of like the trick here. That's kind of the more tricky part. We have to use a different rate than the current day's exchange rate. We have to use the forward rate because that's the rate that we're going to agree on with the broker to try to speculate into the future what the rate will be. So we're going to say, all right, it's going to be the 100,000 times what we speculate the forward rate to be as of the point in time. So today we're saying is 12/1x1, and we're speculating that in 120 days, at the point that we're going to actually get the money, we think the exchange rate will be 0.609. So we're putting this on the books at the speculated future rate rather than the current spot rate, which would be the current exchange rate. If we were to be basically receiving the money in essence today, we would be using the spot rate. So that's going to be the debit, and then the credit, we're going to value the credit at the same valuation at this point in time. Now this rate, of course, is designed to be in 120 days, but it's speculative. So if the foreign currency gets stronger in relation to this rate, in relation to the dollar for the forward rate, then and then at the end of this contract, basically 120 days has passed, then it will be the spot rate because we will no longer be forward speculating. It'll be as of that point in time. And if the spot rate at the end of the contract, 120 days, results in the foreign currency being stronger compared to where it was at the beginning of this, then our speculation would be a benefit. We would benefit from the speculation. Why? Because we would actually be getting foreign currency, 100,000 foreign currencies, which are now stronger than we had originally thought on the first transaction when we put it on the book. So we thought it would be stronger. That's why we did it. But the forward exchange contract, the market had it speculated that it would be weaker. Okay, so let's put this on the books. So we're going to say then this would be a debit here. We're just going to have this go up. And so this represents money we're going to get in the future, but it's going to be in foreign currency units. We're using the current equivalent value and using the foreign exchange to do so rather than the spot rate. And then we have the payable, the 60,900, which we will actually pay in our dollars. This isn't going to change. So this will not change. This will change. If this gets larger, because the foreign currency gets better, this stays the same, then we did good. If this gets smaller and then we get paid off with a lesser valued assets than we had originally thought, then we lost our speculation. Okay, so now we got to put this into QuickBooks. Now, when I put it into QuickBooks, we got to, of course, set up the foreign currency that we kind of looked at last time. We've got to set up the accounts, the receivable accounts that'll be set up, and we have to set up basically a customer and a vendor to kind of line up to these. So let's go back to QuickBooks and think about that. If I go into QuickBooks and I go to the lists dropdown, we already turned on the multiple currencies. If I go into the lists dropdown and we take a look at the currency lists, then we have now added the Australian dollar. So the Australian dollar is on the books. Now, when I do the contract, if it was today, if it was as of today, you would think, well, then I just go down to the activities dropdown or rise up, and I want to download the latest exchange rates. So you could do that, but we're not actually using the latest exchange rates here because we have to use a forward rate at this point in time. So we're not using the spot rate, we're using a forward rate. So we still have to kind of figure that out, what the forward rate will be. So that's going to be a little bit different than we had seen in the past. I also want to go then to the chart of accounts, lists, chart of accounts, and we need to set up the accounts for these two accounts that we'll be using here. Now, you might say we can put these as other current asset and other current liability type of accounts, but we need to set them up as a receivable and a payable account in essence, because those are the accounts that we can assign a foreign currency to. So I want to set these two up as a receivable and a payable, one for the foreign currency and one doesn't need to be for a foreign currency. I'll just set up another payable for the exchange broker account. So I'm going to go to the account dropdown or rise up, and I'm going to go on to the new, and we're going to go then to the accounts receivable type of account. And I'm going to say this accounts receivable will be in Australian dollars. So Australian dollars, so which we have set up. There we go, AUD. I'm just going to call it accounts. Well, I'll call it so I'm going to call it accounts receivable exchange broker AUD to indicate that this is an exchange broker, which will indicate it's a forward exchange contract, and then the AUD for the foreign currency, and it's in the Australian dollar. So I'm going to go ahead and save that. Now the other one, the accounts payable, I could just set up a normal accounts payable because it'll basically be in cash. But I kind of want to set one up, an accounts payable for like the exchange broker, so that I can break this one out and possibly track it separately. So you don't really need to do that if the other side is going to be set up in cash, but I'll go ahead and do that. I'm going to say accounts. I'm going to say new. So they got the rise up, new. And then we're going to go down here to the accounts payable. So accounts payable and continue. And then I'm going to say this is going to be the accounts payable for the exchange broker. And that'll kind of tell us that this will be something different. It'll show up if I had other accounts payable separately, so that we can see then the play between these two items on the financials, meaning you should have them equal and opposite basically on the books. It's nice if it was buried over here in the other receivable or payables, then it would be more difficult to kind of break out and see both sides of it. So I'm going to go ahead and break those two out, so it'll just be plain on the face of the financials. So I'm going to say save and close. So there we have our two accounts set up now. So then if I set up the receivable, now when I enter this transaction, you could say, well, I'm going to do this just with a journal entry, right? You might say, I'm going to just enter a journal entry here to do this, just like I did over here. That might be the easiest way to go. But sometimes QuickBooks will have a problem, one, with the two different accounts having two different currencies, and two, you're working with an account that has a receivable and payable that has subledgers. So oftentimes you can't have a journal entry that has a receivable and payable, and we might want to use the normal forms that would be used to help us to kind of record the transactions and possibly the changes in the rates by entering kind of the normal process that we would for a receivable and a payable. So for those reasons, I'm going to try to use the forms over here to enter this transaction. So instead of entering one journal entry, I'm going to try to enter the receivable side with an invoice, which is typically the form that would be used to create a receivable, and possibly the payable side with a bill, which would typically be the thing that would enter the payable. So let's think about how that will play out. So the invoice needs to be for a specific customer that is related to a foreign currency. So I'm going to set that up separately so we can see that. I'm going to go to the customer center. I'm going to add a customer that pays us in foreign currency. So I'm going to say I want to have a new customer, and I'm going to call this the exchange broker. And I'm going to put AUD to distinguish the fact that this is going to be an exchange broker transaction that is going to be in the foreign currency. And I'm going to put the foreign currency here, which is going to be the Australian dollar, the AUD. So Australian dollar here. And so we're going to say, okay, so let's set that up. And then I can go to the home page and I could set up this side of the transaction. I could set up this side to the receivable with an invoice. The other side will typically go to sales, right? But we'll see what we can do with it. We got the invoice here, and we'll set that up. I'm going to then close out this side. I'm going to set it up for that customer that we just created. I want to make sure it's going to the accounts receivable for the foreign currency, which it is, so that's good. The date here we have on the 12/1, so I'm going to say 12/01/21. And then the item, I'm going to set up an item to do this, and I'm just going to say that this is going to be item 1, and the rate, I'm just going to say, well, I'll keep the rate blank. And then the drop down for the account, I'm not going to put it to income as normally would be the case when you make an invoice. I'd like to make a clearing account here so that it will go into the clearing account. The other side from the bill will go into the clearing account, and it'll then be 0 after we enter the two sides of the transaction. So I'm going to set up a new account. I'd like to make it either an other current asset or other current liability type of account. So I'm going to hit the drop down. I'm going to say other current asset. Let's do that. And I'm going to say this is going to be a clearing account. So anytime there's going to be anything other than 0 in this account, then there's a problem. It should clear out after we do the transactions that will take place at the same point in time. So I'm going to say save and close. And there it will be. I'm going to say okay. So there we have that. And then I'm going to give us the rate, 100,000 Australian dollars. So I'm going to go back on over and say we got the 100,000. And there we have that. I'm going to make this a little bit larger. Now, it's using the exchange rate right here, which was the spot rate that I put in place. Now, I didn't bother going in and changing the spot rate for a current day and time because I would have to, I'm not using the spot rate, right? When I pull these down, we're getting the spot rates as of today, and we need that forward rate. So we would have to have some different rate that it would still possibly be a market rate, but it would be based on a forward exchange contract rather than the spot rate, what we would currently be trading the dollars for today. So we're speculating then in the future then, and that's what we put this on the books for. The rate will be after 120 days, according to our speculation on the market, which would be 0.609. So we're actually going to put this on the books at 0.609. And again, we can't typically get that as easily just simply from downloading the current rates, which would be the spot rates within QuickBooks. So that's a bit of the confusion. Then we got the transaction here, which would be then increasing the accounts receivable for the 100,000 that we're going to be receiving in Australian dollars. It's going to be put on the books at the US equivalent, which currently is going to be the 60,900, given the forward rate that we just used. That matches what we have here, so that looks good. So I'm going to say save and close, and let's check it out. Save and close, checking it out by going to the reports drop-down, company and financial. We'll go on down to that balance sheet standard. Balance sheet standard, changing the dates in the custom reports up top from 01/01/21 to 12/31/21 and OK. So there we have it. So the accounts receivable went up. The other side's going to the clearing account. So we've got one half of the transaction. We've got this half of the transaction on the books. We got this half on the books. Now we got to get this half on the books. We're going to do that by entering a bill because that's going to be basically a payable. So I'm going to go back to the home page. We're going to enter a bill. Now we might want to enter the vendor first in the same way, or we can just enter the vendor as we go. Let's enter the vendor as we go this time. I'll enter the bill. And so the bill means the accounts payable is going to go up. I'm going to set up a new vendor, which is going to be our broker again, but this time on the vendor side of things. So this is going to be the exchange broker, and this is going to be in US dollars. And so I just fixed the spelling of it there. So there we have that, and it's in US dollars. So we're going to say okay, because we're going to be paying in US dollars. So nothing extremely unusual there. So that we'll have that set up, and then we're going to say that this is going to be as of 12. That's correct. And then the amount is going to be for that 60,900. So 60900. So there we have that. And the account is going to go to that clearing account, washing out the clearing account back down to 0. So what's this going to do? It's going to increase the accounts payable. And then the other side is going to be going to the clearing account, bringing the clearing account back down to 0. So I'm going to say save and close and check it out. Save and close, check it out. So then we're going to go to the balance sheet. And so now we've got the accounts receivable on the books at that 60,900. We have the accounts payable on the books for the exchange broker of the 60,900. The clearing account has now disappeared. If I go to the, it's nice to see this in a trial balance as well. If I go to the reports drop down, accounting and taxes, trial balance, then I'm going to say that we have 010121 to 123121. There we have our receivable and our payable. Clearing account at 0. If I double click on it, you can see that we increased and decreased it, which is kind of the point of the clearing account. So now if I go back to the home page, in the future, we're going to be receiving the money. These two things will basically come due in 120 days. We'll also have the cutoff in the middle, meaning we'll have to revalue possibly at the end of the year, and then we'll have to revalue the receivable. The payable should be the same because it's going to be in US dollars. And then, of course, when we have the end of the contract, we'll have the liabilities that we'll have to be dealing with in US dollars, and we will have the receiving of the money, the foreign currency, and then deal with the differences in the exchange rates. When we get paid, we'll have the current spot rate, and then we'll have to compare that to the rate that was used when we put it on the books, which was the forward rate, the speculative rate, and we'll see that in future presentations.